Hello traders, Corey Mitchell here with TradeThatSwing.com. In this video, we're going to look at trading rules for when not to trade. There's a lot of emphasis on entries in trading and even exits, the actual trading part, the hitting of buttons. And that's really only a fraction of trading, because trading is really a lot about knowing when to sit on your hands. It doesn't matter if you can make a lot of money during when your strategy does really well. If you don't know when to back off and you don't have any rules for when not to trade because maybe your strategy doesn't work as well in certain contexts or situations, then you're just going to give all that money back. So there's no point knowing how to trade if you don't know how not to trade. So we'll just go through some examples. What the point is that I want you to develop your own rules, or you should be developing your own rules for when not to trade, looking at your strategies. When do they perform well? When do they not perform well? And even back testing. What back testing does is it's not telling us definitively when a strategy works or doesn't work. All it's telling us is that it worked or didn't work in those specific circumstances that were happening then. And so a lot of people don't really understand that. They make back tests for 2 years, but they don't realize that they were looking at 2 years of the market just trending higher, which is a very different situation than maybe they try to implement the same strategy, but unwittingly they realize now the market's trending lower, it's not working anymore. They wonder why. They back tested for 2 years. It was very profitable. It was profitable during that context or situation. And so what are some rules? So we'll go through some swing trading stock examples, day trading stock examples. And again, some of these charts are old, so these things have been around I've been using them for a long time. Some I still use, some of it I have slightly changed a little bit, but like I said, the point is not for you to follow these exact rules, it's to develop your own rules, and these are just some examples. So, when not to swing trade stocks, I think this is a good one. We can bring in a... Did I delete it? Of course. Let me just pull up a chart here. So what I like to do is, if I'm going to swing trade stocks, I want to see, let's just change this to indices because that's where I have all my notes and stuff. If I'm going to be swing trading, I want the wind at my back. And so I have a couple what I call market health indicators. I also look at the price action of the indices and individual stocks. As you can see, I'm looking at a few different indices. I have a Canadian one up here, Bitcoin, if you're trading it, I have it up there. The Russell 2000, the NYSE Composite, very broad measure of stocks, all different sizes, different indices. NASDAQ 100, and then gold over here, because sometimes a commodity might act a little bit different. So we'll talk about that as well. But let's just take stocks in general. Do I want to be swing trading stocks? And the question that I ask myself is, how are the indices doing? Right, so we can see we're in a downtrend or a correction at the moment. The S&P is where I usually have all these market health indicators on here. And I have separate articles on these, which I'll post in the links. But basically, these tell me, like, are we exhibiting uptrending characteristics, which then gives me a green light to buy individual stocks that I want to swing trade, or are they giving me more red lights, frowny faces, not so good faces? If I want to be aggressively on the long side, I want to see these smiley faces. And as we can see right now, and for quite a while, they have not been smiley faces. They've been ugly. These indicators, this one has to be up above this black line. It's been riding it pretty much for most of the year. This one looks at up volume versus down volume. It's not telling us much at the moment. This one, we're looking for this to be moving to new highs when the S&P moves to new highs, or so this one's actually holding up fairly well. The S&P moved way below this swing low, and this one's just dropped below it. If we go back here, yeah, so this was the corresponding swing low on this indicator, so we are holding up above it. So that's still a smiley face. This one's daily volatility, and uptrends are characterized by lower volatility. It's been, pretty big volatility lately. That's when I put this on there, we hadn't had that big 2% drop, but we had a bunch of close to 2% drops, and 2% drop in the S&P is when I really say, like, eesh, that first one, right? Because like back here, you get that first one, it just says, hey, maybe more downside's coming. If it doesn't, and the price starts recovering, hey, that's fine. You're probably not going to miss out on, much of a move. Here, this told us to stay out, continue to drop a bit. And then if price recovers, hey, we get back in. Same with here. Big drop. There was a little pop, but ultimately didn't go anywhere, so it was still a good indicator to stay out. So that's a very quick version of basically market health indicators, and they're basically saying, yeah, I got a green light to trade individual stocks. I can be aggressive. Or maybe if a couple of them are okay and a couple of them are not, that's like, yeah, maybe we only take one trade, like a very small portion of our capital, and we trade that. Or if most of them aren't good, then it's time to back off totally. So that's how those work. And very beneficial. So you can see an example back here in 2022 where I was just, each week I do a market update and I talk about how all those health indicators are doing, how I feel about trading on the long side or the short side. And yeah, I find that really helps control the losses when things aren't as good. So when times are good, it's a lot easier to make money and pick. Most stocks are moving up, so even if your stock selection isn't great, you're probably going to do okay. But once these start to turn uglier, then stock picking becomes, much harder because most stocks are moving down. And yeah, you no longer have the wind at your back. You are very much fighting the tide or the current. Now, there will sometimes be, especially like commodities or a while back, can't remember, probably a year or more, the semiconductors were really hot, but the market wasn't so good. And you could have, traded in that little specific sector because even though the market, the indices were dropping, there was a specific segment. And an example of that right now is gold. So I have gold here and the gold stocks, the gold ETF and the gold miners ETF. The market's dropping, but like I posted in the recent update, this is an uptrend where, if we get the pullback and we start moving up, those are opportunities to buy. Because even though the market's not so good, this specific sector and, gold stocks, while they are going to be influenced by the broader market somewhat, they're also heavily influenced by the price of gold. So in a sense, this is like their index, right? So be aware of what you're tracking and how relevant it is. If you're looking at just kind of a normal business type stock, it's probably going to more follow the indexes. If you're following an oil and gas stock, then maybe more its benchmark would be oil and gas or natural gas or something like that. So yeah, there are going to be little slivers sometimes of industries or sectors that are doing well when the indices aren't. That would be the exception to the rule, and we can trade in those. But it's usually you can find the index that, like gold, it's moving with the gold stocks. Or gold stocks are moving with gold. So let's talk a little bit about maybe some day trading rules for when not to trade. So that was a swing trading stocks example. And for stocks, I like to see at least a certain amount of movement. When I trade Forex, I pretty much focus just on the euro US dollar. 15 pips of movement in about 2 hours or 10 pips in the last hour is pretty much the minimum I would want to see in order for me to trade. Simply because beyond that, if movement's smaller than that, the spread's going to take up more if you pay commissions. Like, it's just going to whittle down how much you can make. And I've just generally found I'm not going to make a lot when, it's really tightly bound and it's not moving much, and it's probably more likely to be whipsaw and things like that. There is an exception to that. Let's say it is moving 15 pips or 14 pips. This is not, an exact number. You want to think of these as guidelines. Sometimes it might be moving 13 pips in the last 2 hours, but it's making like perfect patterns over and over and over again that suit my strategy. Then I'm still going to trade it. So it comes into play how the strategies are doing in that environment. So if it's low movement and I'm not seeing the patterns form, or once they do form, they're not producing good trades, then I'll stay out. If we do have enough movement and they're producing good trades, hey, great. This was a chart where, this is again a long time ago, 2022, so these rules have been in play for a long time, recording this in 2025. And yeah, this would still apply if I'm day trading the Euro USD today. So we can see some nice moves. Each one of these little lines is 5 pips. So yeah, we got multiple movements going, or quite a bit of movement going on. So 5, 10. This little run here was 15 pips. This last run up was about 15 pips. So we do have some movement going on. When I started, you can see it's kind of become a little stuck, where it's stuck along this edge. There was this swing low. It tried to dip below it. Couldn't really do much. So this is it's starting to get a little bit more range bound. I'm aware of that coming into my session. We'll talk about stocks. The stock's a bit different because, yes, you have the pre-market, but usually the big volume comes in at the open. We don't have this hindsight. With a 24-hour market, you can always kind of see what was going on before you start trading. We don't have that in stocks, but that's okay. We have our own rules for that. So there was some nice movement here. We had some news here, which caused a big whipsaw. And yeah, I marked some trades that I just wasn't really interested in taking. Like, there was a potential setup there, but other than this one kind of news move, even though we popped above it, we didn't really get above that high. So it's just kind of saying like, hey, maybe we're still kind of stuck. Like, you could draw a rectangle around this whole area and it's slightly expanding, right? Like this one expanded below this slightly expanded above, but then it didn't continue that direction. So I'm looking at those types of things. Since I'm generally a trend trader, meaning I'm going to go with the direction of momentum, if price is not following through, so I'm seeing evidence that the price moves up, it pulls back, but then it doesn't really move in the trending direction again, that's information I'm going to use. Like, until I start to see what I call follow through, I'm just going to stay out. So didn't end up getting a trade till way over here. This was probably a little bit late in the sense that there were some opportunities over here I could have grabbed. Even this one, but this was where I started to know, like, it's like, okay, we have a move down that continues. At this point, each move up kind of stifled out, right? Doesn't move up, just kind of comes right back. So yeah, you could have gone long in here and eventually made some money, but it's not super easy money. So I was waiting to kind of see some easier money, and it's over here where we start to see like, whoa, okay, this thing's really following through. If we get a nice setup, we'll take the trade. So there was no issue with movement here. That was not an issue. I had the green light to trade because at least we had 10 pips of movement in the last hour, 15 pips in the last couple hours. And but what told me not to was that there was no real follow through. What I was looking for was not happening, right? Like I said, I'm a trend trader. I want to see price following through, and it wasn't really happening over here. Over here, we start to see, movement and the price following through. Since I trade that type of strategy, that's a good situation for me to be trading in. So I'm more likely to take trades during that time. So stay out when it's not working and when there's low movement. When it's higher movement, which favors me, get in. When price is following through, get in. So that was, just a couple examples of things you can look at in terms of when you trade, when you don't trade. And it's going to take discipline. The price was moving around a fair bit, right? But did it suit my method? Yeah, I could have maybe made a tiny bit, but on other days, I'd just get completely chopped up, and you've likely experienced that as well. You want to trade, so you start looking for those trades, and you end up getting chopped up, losing a bunch of money, and then the nice trade comes along, and you already lost a bunch, and you're not psychologically ready for it. A vicious cycle. So I would rather stay out if things aren't quite right, and then that way when I do see an opportunity, I'm mentally fresh, the capital's there to take advantage. What about day trading stocks? Let's talk about another thing that I like to see. So I just, for each one of these, I put in different examples. You could definitely have a movement type filter for the stocks you trade. And I do this. Like if a stock opens and it's just, just not doing much, it's like not trading or change to a different stock or give it time to see if it eventually moves. But there's not going to be any trading. I want to see some price swings. I want to see, some ranges form, then break out, then, move. And it needs to show movement. It needs to show progress. If it's just stuck whipping back and forth, that's not my environment. I'm going to stay away. So again, you could apply what we talked about with Forex to stocks as well, but I used a different example for this. And do I not have this? Oh, it is just a small image. I'll have to expand that one. Anyway, but I think you can see it here. Let's see if we can bump up the size a bit. So what I was looking at here is, without getting too much into the strategy I trade, but I have something called a TC, which is simply very sharp movement, first pullback, enter when so in this case we had a sharp drop, price drops below a candle low in the pullback. That's the trigger in like the simplest terms. So that would be a short trade. Additionally, it's a trend continuation, so we should have made a lower swing low. So we had a swing low here. Our drop makes a new swing low, so that indicates a downtrend. Downtrends, lower swing lows, lower swing highs. At this point, right, we want to know where this pullback's going. So we only have one element to that downtrend, but we can no longer call this an uptrend. Even though we had this sharp move up, once this drop makes a lower swing low, to me, there's no uptrend here, because uptrends are higher swing highs, higher swing lows. As soon as we make that lower swing low, that uptrend's in question. So now the question is, do we get a lower swing high? As long as we're at a lower swing high, so I would be looking for a trade. If it got way up in here, I wouldn't like that. That's too deep of a pullback. But basically, if it pulls back anywhere kind of below what I call this kind of a crotch area, this is where the price ultimately reversed. It got as high as there, but this was kind of our confirmation where the price was starting to pull back. So if it gets up into here, that probably be about as high as I want it to go. So I'm looking for a pullback basically anywhere in this area here. So that's kind of the very simple definition of the strategy. Of course, trading is not easy. I'm not going to say that, it's super easy to trade, but this is the strategy. So we have a lower swing low in play. So we're looking for a pullback and then for the price to drop again. So now what I have to look at, before I can even consider a trade, what I want to do is I want to measure out how big was this drop. Because now when this does pull back, let's say I'm considering this trade, you can see I put a stop loss here. So as that candle's formed, before this even red one's formed, for each one of these candles that form, I can measure it out, and actually I have an indicator down here which says what the size of the candle is. And I can measure that out and say, okay, so my stop loss needs to be 50 cents or 25 cents or 30 cents. If I want to get a positive risk reward, then I want to know that there's enough momentum. Basically, we could say if this was duplicated, if this drop was duplicated, and then take off a little bit. So be conservative and say, so this one dropped from $28.50 down to almost $26.50, so almost a $2 drop. Let's say the next drop is only $1 to $1.50. Is this entry point here the stop loss size? If I multiply it by 2, so we can see stop loss looks like it's about 25-30 cents. If I multiply that by 2, that's going to be my profit target. So I'm risking 25 cents or 30 cents. Let's just say 30 cents. To make 60 cents, is that inside what I just talked about? Well, we had talked about this drop being almost $2. So if the next drop is $1, which would only be half of this, if I'm going short here, then a $1 drop should be able to easily reach my target. Basically, this is the only movement we know so far. Well, and this up move and this down move when I'm taking this trade. And if I look at these and I say, okay, if I go short here, is there enough movement here to potentially easily hit a target of, let's say, 60 cents? Then I'll take that trade. If this candle was really huge, right, and then I'm entering below the candle and my stop loss has to be way up here, now all of a sudden the trade doesn't look as good, right? Because if it pulls all the way back up to 28 and drops to 27 and I entered down here, we can see my risk would be, this whole amount, and my profit potential is only this. Now, yeah, maybe we do get a bigger move, $1.50, $2 down, like we did on these moves, but I'd rather be more conservative. I'd rather put my target within movements the market's already been showing. If it's been moving up $1, I'd rather assume it's going to move up, 75 cents. And I mean on each wave. So it moves up 50 cents, then it pulls back, then it moves up 40 cents, then it moves down, then it moves up 60 cents. Those are showing kind of 50-ish cent type movements. I'd rather be on that more conservative side and say, like, yeah, okay, maybe it's going to move 25 cents up. And at that point, assuming that there's going to be less movement in the direction I'm going, is my profit target still likely to get hit? That's the ultimate thing. So you can see here, so let's say the price dropped 50 cents in 2 or 3 candles, setting a downtrend. The price pulls back and I'm waiting for my short trigger. It's only going to require a stop loss at 10 cents. I typically use a 2-to-1 target. So my target's going to go 20 cents below my entry. But my target plus my stop loss is 30 cents. So let's look at this example here. So basically what I'm saying here is that the target plus the stop loss is within the movement we've already been seeing. So let's go through this one more time. 850, let's just round it to 28.50 to 26.50. We know it's a little bit less than that. So this is a little less than a $2 drop. So you could draw a line on this wave, and then as this pullback is forming, you can just duplicate that line to the downside, and you would basically want your trade within that line, right? So if you duplicate this, draw a line over it, and then as this pullback progresses, duplicate that line to the downside, and your target should be well below the bottom of that line. So $2 drop. As this moves up, let's say, okay, if we get a trigger at this point, we don't know that red candle is going to occur. As this is moving up, once the price drops below that, we should already have our line drawn, because we can have it drawn as these are each forming, because we already know our trigger is going to occur if we drop below a candle. So at this point, we could have our line drawn down to, it would be 27.25, so drawn down to about 25.25, right? So a line would be drawn down to here, and you can see that target that I put out is well within that line. So does that make sense? It's basically like you have a $2 drop, then you have a pullback. We can expect maybe up to a $2 drop off the high of that pullback. Of course, we don't know at the moment. When we take that trade, that's going to be the high of the pullback. But that's trading. That's as long as we have a positive risk reward, we're not going to win all our trades. It could have triggered me in and then kept going up a little bit. I would have lost. Then I'm reassessing. Do I still want to take the trade? How's the risk reward looking? Does it still look like it's a downtrend? All that sort of stuff. So that's another one. Basically looking at size of movements relative to your profit target. Is it going to be easy for the price to hit your profit target? This can get slightly more complicated if we have choppier movement. So in this case, it's pretty decisive. We can see a big drop, a pullback, and I'm basically assuming like, okay, we had a big drop, we got the pullback. I'm expecting somewhat of a big drop again. But what if the trend's a little bit tamer? It's like moving up a little bit, moving down a little bit, moving up a little bit, moving down a little bit. In that case, you're probably not going to get out on, the next little up wave, right? Because that's only going to give you a tiny bit of profit. You may have to hold through a few of those in order to hit a decent profit target, because the price is just kind of meandering very slowly, but it is moving a direction. So that's one of the reasons I do prefer to see some movement in my stocks, is that it's easier to get in and out quickly when you have quick, decisive movements. But sometimes we don't have that option. We only can, what we're trading or what we've decided to trade that day, or pretty much everything we look at, is much more grindy movement. There are trends going on, but they're not swift moves. And in that case, you're going to have to kind of measure out, what do we think we can get overall out of this move, as opposed to just in quick bursts like what we're getting here. So examples would be like over here. You can see the price is meandering, but it's moving a little bit slower. So we do have to account for the strategies. If all you've ever practiced is in this, then you know when the strategy works and doesn't work in these sharp movements. Then you can start incorporating, hey, do I want to trade it in a little bit grindier movements? And that would be, in addition to the strategy, to be able to trade this TC type pattern in grindier movement. But it's going to change the psychology a bit, because now you may have to change. If we were going long, we'd have to hold through a few of these little up waves, in order to realize our profit. So understand, again, strategies are profitable or unprofitable based on the conditions they were traded in, and of course how we executed them. And that's all they tell us, right? Were they good in that condition? So that's why we need these types of rules, to understand when the strategies work, when they don't work as well, highlighting when we need to stay out, so that we capture this. But then if all of a sudden it gets really like grindy and choppy, we're not trying to trade this same pattern when now we no longer have the movement. Things is just kind of like oscillating, whipping around. That's not the same pattern. That's a different context. You cannot just try to apply the strategy in that situation because the strategy was built for movements like this. And then it can be adapted and applied to maybe, movement like this, but that's going to take practice, and it's going to take some additional rules to tell you, okay, when do I trade that? When do I not trade this type of movement? One thing about mental preparedness, so I'm always looking at my own psychology because it's important. So as one kind of final guideline for when not to trade, even if a trade setup comes along and I think it's good, but my mind is just not in the right place, like I feel like I just don't think I can execute this trade, then I won't. So an example of this often occurs for me, like all the time, is I kind of have a window that I like to trade in. For stocks, it's the first hour or so of the day, maybe an hour and a half. Forex, kind of the same thing, like around an hour and a half. If I'm up for the day and, we're kind of getting close to that time when I usually wrap things up, I really have a hard time mentally committing to that last trade. What will usually happen is I'll put on just like a partial position size. And the reason is because I know I'm coming to the end of the session. It's been a good day. I don't want to give back a bunch of profit like when I'm right on the cusp of kind of being done for my trading time. And there's not that usually anything that's forcing me away from my trading time, like I have to go do something. It's just that's usually when I start to kind of mentally check out. And so that right near that cusp of the cutoff, I have a hard time committing to trades. That's just one example where it's like, okay, if I'm going to take it, I'm only going to take a partial position size, but usually I'm pretty eager. I just know myself. I'm pretty eager to take my profits quickly. Most of those trades, I don't end up letting hit the target or the stop loss. It's like, okay, made a little bit, lost a little bit, whatever. Let's just get out of here. So I'm not mentally in the game for that trade. And so I probably just answered my own question. I shouldn't be taking it at all. And most of the time, I don't. It's like, just call it a day. You've had a good day. So the reason could be anything. Maybe you had a fight with your spouse. Maybe, the kids are screaming outside the door. Maybe whatever it is. If I can't really commit to following through on that trade according to my plan, then I shouldn't be in it. And that means for a lot of people, they will never take a trade. And that's the sad truth because they have not done the mental work outside of trading to, find the composure, find the discipline, find the patience, and, I have tons of articles on that type of stuff in the trading improvement section. Stuff we can do outside of trading to make us less stressed, more calm, more perceptive while we're trading, noticing our setups, being able to follow our trading plan. Yeah, if I don't feel I can do those things, because that's the ultimate goal. The goal is not to make money. The goal is to follow the trading plan, to follow the strategies, to follow all these guidelines and rules I've laid out for myself. If I cannot do that, then I shouldn't be trading. And definitely not trading at full size. Obviously, there is a learning curve when you're first starting out. Everything's going to be tough. Everything's going to be a mental challenge. That's okay because you're probably trading a demo account, or you should be trading extremely small position sizes, which, yes, it's trading, but you're not, risking your financial situation or anything. And so that's, something else to consider. Your mental state and how that's going to affect when you trade and when you don't trade. So it's got longer than I expected because I dug into details on these little, some of the strategies and things like that as well. But hopefully you found it helpful. And I'll post the link to this article if you want to see the trading rules and examples. And happy trading out there.